Well, this week, Fed Chair Jay Powell's speech had investors holding their breath for signs of what's next for interest rates. Powell is set to speak again this afternoon, but it's not expected to announce any big decisions. Just this week, the S&P 500 and the NASDAQ both hit their longest streak of gains in 2 years. For more on this, we've got Callie Cox, U.S. investment analyst at eToro. And Callie, let's begin things right there. What really here is the catalyst for the extended gains that we had seen, especially in the S&P 500 and this win streak?
Yeah, well, the headline catalyst is the Fed and what Powell said in his post-meeting press conference last week, basically pushing back on the fact that the Fed, may institute one more hike without making any promises, and talking about the balance of risks, how inflation has made so much progress, but how they're also, worried about the weakness we're seeing in the job market, which to the Fed, or to investors, might mean that the Fed can be flexible on policy.
Callie, we heard from Jeffrey Gundlach during YF Invest, our summit here earlier this week. And our colleague Brian Sazzi asked him just about the risk of recession, what stocks would potentially be under the most amount of pressure. He pointed to the fact that the Magnificent Seven could take a pretty substantial hit. What's your outlook on that? And I guess, are you right now avoiding some of that exposure?
Yeah, we're actually leaning into that exposure. And of course, we don't manage money, but we're telling customers to think about quality risk. Now, I can't argue with the bond king here. I mean, Jeff, of all people, probably has a better feeler on the economy than most of Wall Street. And I still think a recession is a risk. There's immense pressure on the economy right now, but you have to think about a few things, right? This recession risk, or this recession worry, has been in the market for so long that investors have had time to prepare for it. And I consider them, anxious and fearful at the moment. That's a good support for markets. But you also have to watch the companies that you're investing in right now, because interest rates are high. Recessions are known for washing out the weak hands in the market. And you have to think about which companies are durable enough to survive a recession. When you think about that, it's hard to look past big tech.
And where are the market's weak hands right now, then?
So I would look at smaller speculative companies. So small caps have actually been catching a lot of attention. They're having the worst year relative to large caps since 1998. And that's for a reason. Small caps are domestically focused, so they're hit by the double whammy of slowing growth and high interest rates, because they're more sensitive to interest rate hikes. So, if you're a longer term investor and you're willing to look on a broader perspective, then small caps may be a good buy here. But, if you're looking for opportunity over the next 3 to 6 months, I would probably veer toward that larger, quality company risk instead of that, smaller, speculative, unprofitable risk.
Callie, you mentioned earlier here this morning that the Fed could potentially be flexible on policy. More specifically, what do you mean by that? And I guess, is there a case to be built that maybe the Fed is actually done?
I think there's definitely a case there. We've seen a lot of progress in inflation. Jay Powell knows that they've hiked quite a bit, and they could probably achieve more if they keep rates higher for longer. And to be honest, what will a 25 basis point hike here actually do, other than, shake market confidence at a time where the Fed wants to tread carefully? So, we don't have a crystal ball. Nobody does, but we see a good case for the Fed being done here. And for now, that's good news for stocks, because we're not seeing recessionary evidence elsewhere.
Yeah, my crystal ball's in the shop right now, so I'm hoping they get that back to me sometime soon here, Callie. Ultimately, as we kind of look into next year, where are you seeing investors place some of their top ideas, and perhaps what is the prevailing thought, even as we get into 2024, if the rate strategy that you were discussing holds true?
Well, there's a trade behind this. Basically, everything that didn't work in 2022 when rates were rising could be back on the table for 2024. And we're already seeing that over the past 8 days in this, ridiculously fierce rally that we're seeing in markets right now. It's being driven by those rate sensitive sectors, tech, real estate, consumer staples. People were really caught off guard by the fact that, yields rose so much, and then Jay Powell threw water on all of that. So we're looking at the rate sensitive sectors. We still have a bias toward those big quality companies. But most of all, we think that you can't give up on this market. It's a bull market until proven otherwise.
All right, Callie Cox, always great to get your insight. Thanks so much for taking the time this morning. U.S. investment analyst with eToro. Thanks, Callie.